Will there be another financial crisis? Yeah.
Yeah, you think?
Of course there will be. Because the fact is that debt grows exponentially and liquidity is cyclical. And debt ain't going out of fashion. Politicians are just kicking the can down the road. They're taking on more and more debt. The more that central banks paper over the cracks, the more they pump in liquidity, the more monetary inflation you get, the higher the gold price goes and the higher Bitcoin goes. Enjoy the party, but dance near the door.
Hey everyone, I'm here in London with the king of liquidity himself, Michael Howell. So Michael is the managing director of CrossBorder Capital, the developer of the global liquidity cycle and the author of Capital Wars. Maybe first of all, for all the viewers who might not know you, could you briefly introduce yourself and why have you been watching liquidity for so long and since when?
Okay, well, hi Jack, great to be here. Much looking forward to our discussion. If I go back in my career, and basically I started off in investment banking with a US firm called Salomon Brothers. Salomon Brothers was the probably the bond markets worldwide. It was the biggest fixed income trader worldwide. It did lots of work in forex markets. It was basically trying to understand, or actually it was transacting a lot of these capital flows that we now describe. And part of the research process at Salomon Brothers was actually understanding the direction and the size of capital flow worldwide. And the view very much was, if you could understand the flow, you really understood how markets were likely to move. So it came from practice, looking at how markets operated and basically doing an awful lot of data collection. And that's pretty much what we've been doing, for 25 years since then. So it's collecting data from central banks, collecting data on capital flow worldwide and putting that together in a framework that allows us to understand global liquidity movements and hence their impact on asset markets.
Yeah, so that's why I want to talk about you today. So basically today we're going to talk about how global liquidity affects Bitcoin.
Mm-hmm.
But first we need to understand, so Michael, what is global liquidity?
The way that we define it is the flow of money, and by that we mean credit and savings through financial markets. It's not, and I stress this point because it's important to say what it isn't. It isn't traditional measures of money supply like M2 or M1 or these sort of things. They're really measuring, if you like, money in banks, in high street banks. And if you believe that retail deposits in banks are what the financial system is about, well, I'll come quietly. But unfortunately, the world has moved on an awful lot in 20 or 30 years. We now look at very broad measures of liquidity that include shadow banks, include what central banks do, include what foreign investors are doing cross-border. So it's a very, very broad analysis of flows of capital or flows of money.
And can you maybe continue on the difference between global M2 and global liquidity? Because when I look at a lot of analysis, I see a lot of analysts just saying global liquidity is global M2, but that's not the case.
Yeah, I think one of the great problems with economics is that things that you can measure easily become very important. Because a lot of people are very lazy and they don't dig behind published statistics. And the problem with looking at things like M2 is that M2 is really measuring the deposits, in other words, the liability side of retail or high street banks. Now, high street banks are no longer the mainstay of the financial system. If you look globally, the answer would be that probably they are responsible for maybe something like 40% of total credit. So they're important, but they're certainly not the big size they used to be. If we go back maybe 40, 50 years, then I'll accept the fact that high street banks were very important in the financial system. Now they've been eclipsed by lots of other forms of credit. Shadow banks I mentioned, central banks are important. There's a lot of credit which is basically created through what are called FX swaps.
Yeah.
These are things which are outside the normal remit of high street banks.
Yeah, so you touched a little bit on it. So what are generally the main drivers of global liquidity?
Well, the answer comes down to really two factors. One is what the central banks are doing. We can drill down into that equation. But what that really boils down to is essentially trying to understand the two big central banks in the world. One is the Federal Reserve, maybe quite obviously, and the other is the People's Bank of China. And their influence tends to be rather different. So the Federal Reserve if it changes the structure of its balance sheet or eases credit, it will have a major effect on financial markets and financial asset prices. And that's largely because we're on a US dollar standard. If the People's Bank of China changed monetary policy, it tends to affect the tempo of the Chinese economy. And because the Chinese economy has such a large industrial footprint, it will affect then global economic activity and commodity markets. So you could broadly say in very crude terms that the Federal Reserve controls the asset markets and the PBoC, the People's Bank of China, controls commodity markets. Now, that's the central bank element. There's another element that we've got to think about, which is how the private sector then creates credit from that base. And what's important to understand then is collateral. And ever since the global financial crisis in 2008, pretty much all lending now is somehow collaterally based. Now, many people will be familiar with collateral in the sense of thinking of a home mortgage. So if you're borrowing money to purchase a house, the loan is collateralized or backed by the real estate that you're buying. So that's a mortgage. But most lending now is sort of mortgage-like in a sense that it has collateral, but that collateral tends to be things like government bonds. And the most frequently used collateral is US government treasuries. So those treasuries back lending. Now, that makes up the collateral base of the financial system, and it operates alongside what the central banks are doing. And we think of what's called a collateral multiplier. In other words, how many times that collateral can be used and reused within the financial system. And that collateral multiplier tends to be something like about 1 3/4 times. So every, let's say, every $100 of collateral in the form of, let's say, treasuries can be multiplied, can almost be doubled in its effect on creating liquidity. Now, what affects the size of that multiplier is basically the assessment of credit providers, in other words, those people that are making the loans, as to how volatile or how or the prospective prices of the collateral in the future. So, for example, if the collateral that you're posting, a government bond, or if you take my analogy of a house, goes down in value substantially, then they would want protection. The lender would want protection against that risk. So the way they judge that is looking at the volatility of the collateral. Given the fact that it's mostly these days government bonds, what is important to look at is something like the MOVE index. The MOVE index is like the VIX index, but the MOVE index measures bond market volatility across the US Treasury curve. And the MOVE index tends to influence the amount of or the effective use of collateral in the system. In other words, it drives the collateral multiplier. So what I tend to say as a quick and dirty way of understanding liquidity is to say, look, you really need to look at 3 basic things. One is what the Federal Reserve is doing in terms of its liquidity injections. 2, what the People's Bank of China is doing with its liquidity injections. And 3, the effectiveness of collateral measured through the MOVE index. And if you get a falling MOVE index and rising liquidity inflows from those 2 central banks, then global liquidity tends to rise.
Yeah, and also from your book, I read cross-border capital flows are very important. Maybe if you could elaborate on that a little bit more, because let's say if you send money from one country to another country, how does this add liquidity? Is it because of the extra credit creation or the leverage, or how does that work?
Well, it's a great question. I think it's. I think one has to clearly bring into account cross-border flows. They're a vital part of the international financial system. And the way that they'd operate is that if you've got, let's say you've got dollars which are moving across borders, foreign banks or credit providers can use those dollars themselves as collateral, and they can lend against them. They can multiply that. So movements of reserve currencies, if you like, can be very important in that equation of actually creating liquidity. I mentioned earlier FX swaps. FX swaps are another way of creating liquidity. And that's just effectively, swapping out of one currency into another currency. But if you're again using the dollar as one of the currencies in that cross, then that dollar can be used as collateral that can be multiplied further. So it becomes complex, but it's very important to bring that side in. Now, if you look at the evolution of the global monetary system, and we go back probably 10, 15 years, the euro-dollar markets were very important in terms of creating credit outside of maybe what the Federal Reserve was doing. and think of the euro-dollar markets as an independent pool of dollars that banks worldwide could dip into to actually create credit. Now, that pool of euro dollars has shrunk significantly in the last 10 or 15 years, largely because of increasing controls from the US Federal Reserve and the US Treasury. So the euro dollar market, although we don't really know the true size of it, hasn't really expanded in 15 years. It's still around about circa $15 trillion from, according to BIS estimates.
Yeah, it has to be really hard to measure the cross-border flows. Is this maybe the reason some people leave it out of the global liquidity? And how do you measure these flows?
Well, I mean, the way we do it through we do a lot of data collection, and we're looking and talking to central banks and financial systems around the world. So we piece these flows together. So we've got an idea of the size of cross-border flows in the markets. Now, where those cross-border flows really matter tends to be when you're thinking about emerging market investment, because flows of money into emerging markets tend to be huge drivers of their financial systems. And if you start to see liquidity via cross-border capital moving into, say, Asian emerging markets, then what will happen is the local central banks will monetize those inflows for the simple reason they don't want their currencies to rise, so they'll print money at the same time, in other words. And that will create a huge domestic credit expansion. And that's one of the things we may be about to see looking forward, because what we're seeing now is a falling dollar, and it may well be that that's reflecting of money moving outside of the US again.
Yeah, so good that you say moving dollar. So maybe let's talk a bit about the US Federal Reserve. So if I understand it correctly, so we currently live in a world where we have a lot of outstanding debt. And to be able to refinance this debt, we need to roll that over with new debt. And you already said as well, so the balance sheet capacity is more important than the interest rates.
Mm-hmm.
But the thing is, so right now, I think it was a couple of days ago, the Fed cut their interest rates by 50 basis points. So how will this affect global liquidity? Will it affect it, or is that not that as important?
Well, I think it's an interesting philosophical point. I mean, the thing is that interest rate cuts per se don't necessarily increase liquidity. In actual fact, I mean, one of the paradoxes of recent years would be to say that actually increasing interest rates may be a greater source of demand in the world economy, ironically. And the reason for that is that governments have now got so much debt, they're sitting on so much debt, that if their interest bill goes up, that's clearly a transfer payment to the private sector. So in other words, if I'm holding a government bond and interest rates go up, I'm going to get more income. So you've got to start thinking carefully about maybe how the financial system has changed where there's so much debt around. Mm-hmm. And it may well be, paradoxically now, that actually if interest rates are being cut, it's actually reducing demand in the world economy. And that may be a paradox, but it's worth speculating on that. Now, to come back to why interest rates are less important and maybe why liquidity is more important, which I think is a key point for everybody to understand because it's not the normal textbook view. Generally, if you pick up an economics or a finance textbook, it will tell you that interest rates are what matter. Interest rates govern the cycle of capital investment, and using a sort of traditional Keynesian model, if capital spending goes up or comes down, it's multiplied through to a bigger increase in GDP, and that's what creates growth. And we sit looking at a 9 to 10 year business cycle, which is really that capital investment cycle. And behind all that, capital markets stand as new capital raising mechanisms. Now, on all those counts, the world is different, okay? There's not a great deal of capital spending going on, or if there is capital spending going on, it's operating in China, which doesn't operate along these lines. It's just effectively the state is allocating money for capex. So that's point number one. Point number two is that against that backdrop of not much capital spending going on, what financial markets are doing more and more of is actually refinancing or rolling over existing debts. In the world economy right now, there's something like $350 trillion of outstanding debts, private and public. And those debts have to be repaid at some stage. And on average, they have a maturity of about 5 years, which means that you've got on average $70 trillion to refinance or roll over every year on average. Now, some years it may be 30, some years it may be 60, some years it may be 100. So that's not evenly distributed. And one of the things you will hear people talking about in markets, even right now, is the thought about the maturity wall. And the maturity wall basically represents the fact that over the last few years, in a low interest rate environment, a lot of corporations have refinanced their debt opportunistically with low interest rates, and much of that is maturing around 2026. So what you've got is a maturity wall, which has been very low for the last 2 years, but it's really starting to emerge again in around 2 years' time. Now, the reason these things are very important is that if you've got these debt rolls to undertake, on average $70 trillion a year, you need balance sheet capacity to do that. And balance sheet capacity in the financial sector is liquidity.
Yeah.
I mean, that's really what it is. So you need liquidity in the system. And what you tend to find if you look over the long term is that there is a long run ratio, constant ratio between the amount of debt in the system and the amount of liquidity. And if you start to see debt rising relative to liquidity, you risk refinancing problems. And if you get refinancing problems, you get financial crises.
Yeah.
And every financial crisis that you can think of going back over the past few decades has fundamentally been a refinancing crisis. Think of 2008. Think of the Asian financial crisis in 97. Think of the US repo crisis in 2019. All examples of refinancing crises. So you need liquidity. So the whole idea that central banks can undertake QT, forever is completely fanciful. They've got to come back and they've got to expand their balance sheets. And that's what we're beginning to see again now.
Yeah, but so currently the Fed is still in QT, and when will they move towards quantitative easing?
Well, the Fed in theory is doing QT on paper. There's a difference between in practice and on paper. And although they say that they are doing QT, what they define now as QT is basically reducing the headline size of the balance sheet. Now, prior to their QT exercise, they used to define QE as expansions of liquidity, not as expansions in the size of the balance sheet. So they've changed the definitions very subtly to their own advantage. And if you look within the balance sheet and you look at the liquidity creating elements of the balance sheet, you'll find that since late 2022, so almost 2 years ago, they have been expanding liquidity into US financial markets.
And how does this quantitative easing work in reality? Is it because some people just say it's money printing, but how does this work in general?
Well, it is money printing, in a sense, yes. Now they're creating. I mean, any way that you're creating credit in a credit money economy is effectively printing money. So yeah, sure, they can't deny they're doing that. The question is, what's the scale of it? And I think what you've got to understand, or people have got to understand, is the way that let's say the landscape of the financial system has changed radically in the last few years. Now, partly that's about the Federal Reserve and about the central banks, and partly it's about the governments and the finance ministries or the treasuries, how they operate. And let me fix on the US, not because the US is necessarily the bad guy, but because the US is very transparent. It's a big economy and it's actually very easy to understand. And if you look at the Federal Reserve, first of all, the Federal Reserve, as I said, since late 2022, has been expanding liquidity in the system. And it's basically done that through increasing elements on the balance sheet that obviously create liquidity, but by definition, things like Fed credit. So Fed credit into the system has increased, and the withdrawals that the Federal Reserve or the Treasury make from the money markets have declined. Now, what people would tend to look at, or what we look at, and this goes back a lot to the time I was at Salomon Brothers, and Salomon Brothers put a lot of effort into Fed watching, back in the 80s and 90s and whatever. And the way that we used to look at the Federal Reserve was basically to look at elements on the asset side of the balance sheet, like Fed credit. You would have to add to that any operating losses that the Federal Reserve was making, because that's effectively giving money to the banks. And on top of that, you would subtract things like the Treasury General Account, which is basically a withdrawal of cash out of the money markets by the US Treasury. The US Treasury just builds up its bank deposit account effectively at the Fed, and that's taking money out of circulation, or newfangled things, like reverse repos. And reverse repos are a slightly wonkish concept, but it's basically, what's happening is the Federal Reserve in this case is taking money out of the system and supplying very short-term paper to the market in return for that. So these are the technicalities. But if you look at that equation of Fed liquidity has expanded pretty consistently since late 2022. And it's going to go up more because in the next few months, we're heading towards the reimposition of the debt ceiling in the US. And that debt ceiling, as part of its requirement, is that the Treasury General Account is actually pared down to quite low levels, low operating levels. So there's more Fed liquidity likely coming. So if you look at the Federal Reserve is clearly doing what I would describe as not QE. Okay, so they say they're doing a QT, but that's only their own definition. It's basically disguised QE, and that's going to continue. The second thing to look at is what the Treasury is doing, and the Treasury has been particularly clever. And Janet Yellen at the Treasury has won my applause in terms of what she's done, because what they've managed to do very cleverly is to change the structure of funding for the US government. There's an increasing proportion of funding which is now done through Treasury bills. A Treasury bill is an instrument, a government security of up to 1 year maturity. It pays no coupon, but it's basically sold beneath par and redeemed at par. A Treasury bill Treasury bills now account for about 22% of total US debt. The other thing they've done very cleverly, and without very much commentary, in fact, is that they have reduced the average maturity of bonds sold at their through the calendar when the Treasury comes to the market and issues government debt. The average tenor of that debt has dropped by about 1.2 years since the end of 2022. Now, in fixed income terms, that's quite a big drop. So in other words, to put it in granular terms, they're no longer issuing 10-year bonds or 20-year bonds or 30-year bonds. They're issuing bonds much closer to 2 years, 3 years, 5 years, 7 years. So the whole focus of Treasury issuance has changed or shifted in maturity from the long end towards the short end of the market. Now, why is that important, you ask? Comes back to your point about monetization, printing money. Because who tends to buy long-dated debt in the markets? In other words, 20-year or 30-year bonds, it tends to be pension funds or life insurance funds. And those funds are simply dipping into existing savings. So it's just a reallocation of savings from one pot to another. It is not monetization. It's purely a direct funding out of existing savings. So there's no problem with that. Or the only problem could be is that if there's not the appetite for bonds, interest rates will clearly go up. If you fund at the short end of the market, in other words, through bills or short-dated bonds, it tends to be the banks or the credit providers that buy those instruments. And the reason being is if you think about what happens when the government is running a deficit, if the government's running a deficit, and let's say it's because I'm the government and I'm paying you as a government worker, and you put the money in your bank account, the bank's balance sheet will be misaligned because it's received a deposit and the deposits or its liabilities now exceed its assets. So it's got to find a matching asset for that deposit. And what better than a short-term government debt, like a bill or a short-dated bond? And that's exactly what happens. Now, the difference between these two cases, which, as I say, may be somewhat arcane or wonkish, is the fact that in the pension fund example, banks' balance sheets didn't increase. In the second example, they've increased. And any increase in bank balance sheets or credit providers' balance sheets is a liquidity expansion, and that's a monetization. And this is what's happening in the US. If you look at this year, something like, to go back to your statistic of M2, M2, as I say, is measuring high street banks' balance sheets. But if you look at M2, for example, about 3/4 of the increase in M2 this year has been through direct monetization of the government deficit. Big number.
And then the only thing I don't understand in that is how can this refining system continue to survive in the long term? Are the policymakers hoping on AI or some technical advancements, or will we just live the next decade with higher than normal inflation?
Well, I think that's the $64,000 question. Can the politicians keep kicking the can down the road? And I think the examples, from history are enlightening, but maybe not very encouraging. And if you look at the two instances, or actually there are three instances I could cite of big debt increases. Okay, now the first of those came after the Napoleonic Wars, and the British economy saw a big increase in its debt, public debt, to pay for the wars against Napoleon in Europe. And that caused the debt GDP ratio for the UK to skyrocket. Now, that period, the subsequent period, saw the debt GDP ratio of the UK come down quite appreciably. But you've got to remember what was the background. The background was the Industrial Revolution, and productivity gains were huge. Now, you could also say that that wasn't a particularly comfortable period for people that were in the working class to actually live, because they had to work, long hours under terrible conditions. But there was a big increase in productivity in the UK economy, and the debt GDP ratio came down. So park that thought. The other two examples basically come immediately after World War II, again featuring the British economy, where the debt GDP ratio was again sky high through the late 1940s and 1950s, but it did come down. Now, that period for the British economy wasn't a particularly great one. In actual fact, the subsequent decades have not been great. The British economy has never come back to its former strength because of that big debt burden. And it was only really reduced because of a baby boom in the post-war years, which actually led to faster GDP. So that was another way of sort of getting debt down. And all of the welfare systems that were then enacted by the British government and other governments were pay-as-you-go systems. So they depended on the young workers effectively paying in, and they could offset any older workers that were retiring or needed welfare benefits. The trouble is that equation has now gone dramatically the other way. So you haven't got young workers coming in, you've got a lot of older people needing welfare. Third example is Japan. And Japan has got sky-high debt GDP ratios. But again, the Japanese economy is suffering. Japan is not like it was in the 1980s. It's not seeing big productivity gains. It's an old, aging society. It's suffering from, bouts of deflation from time to time. And although the Japanese standard of living is pretty decent, it's certainly not advancing. It's being caught up by a lot of other countries, particularly if the yen is weak as it has been in the last year or so. So you've got these examples of saying that economies can survive with high debt to GDP ratios. The Japanese wake up every morning, they eat breakfast and whatever, and they go to work and everyone seems comfortable. But the economic lifestyle has changed. These are not dynamic economies. And that's the problem you get when you get large amounts of public sector unproductive debt in an economy. Growth tends to slow. And that's the issue we've got to face. So it's quite feasible that you could see these high debt GDP ratios persisting for a long time. Politicians will kick the can down the road because they're never going to tackle them. And so what you need to finance these debts is more and more liquidity. Now, as you rightly allude to, that liquidity is fungible. It moves, in other words, and it can spill over into other areas. So it can spill over into asset markets, which it does do, and it drives asset prices higher, and it spills over into the high street and creates inflation. Now, what's the difference between monetary inflation, which I've been talking about in terms of the expansion of liquidity, and high street inflation, which is really what bothers most people when their consumer price baskets go up? And the answer is there's a close but not exact connection. And monetary factors or monetary inflation is an important ingredient into consumer prices, but it's not the only factor. So you've got to think about oil prices. You've got to think about productivity gains, in other words, technological advances. You've got to think about China dumping cheap goods into Western markets, tax changes, oil prices. All these things come into the consumer basket, but they're not about monetary inflation. So monetary inflation in the last 20 years has been quite substantial, but high street inflation has been very low. And that's because you've seen, by definition, cost deflation through these other factors. Now, the question to ask is, looking forward 20 years, are we going to see the same degree of cost deflation? Well, maybe, but that's a projection. And I would be skeptical, are we going to see the same amount? But, I may be willingly or happily surprised in the event, but who knows? But you have got a lot of monetary inflation. And monetary inflation seems to be running on at a rate of something like 8 to 10% per annum, which really means that the stock of liquidity is doubling within 10 years, every 10 years. So what that basically means is that if you start to think about asset markets, if asset markets need to keep pace with monetary inflation, they've got to double as well every 10 years. So what are the assets you need to own? Now, spoiler alert, gold has always been a very good monetary inflation hedge. And if you look back since year 2000, the stock of US government debt, federal debt, has increased eightfold since year 2000. The price of gold bullion has increased by about 8.5 times since year 2000. So gold has been a great hedge. Now, we know Bitcoin has actually done even better than that, but that may be a sort of an unfair statistic because there's new take-up as well coming into Bitcoin. But you want to think seriously away from the traditional 60-40 asset allocation mix with 60 equity, 40 bonds, because that is not going to work in a world where you've got monetary inflation. You need to diversify the 40% that's in bonds into lots of other areas. You've got to think about gold. You've got to think about cryptocurrencies. You've got to think about treasury inflation-protected securities, in other words, index-linked bonds. You've got to think about prime residential real estate. You may even think about commodities.
Great answer. So to recap, so you actually don't think the Fed will be able to keep its 2% targets in the future?
No. I don't think that. I think that's right. But I think the reality is if you start to drill down into the data, the underlying inflation rate in the US or the way the market is envisioning long-term inflation is not the 2% that is represented as break-even inflation in the bond markets. I think it's much higher than that already. I think it's nearer 3.5%. And the reason that you can get to that figure is that the Treasury, as I said, is sort of fiddling the cards here because they're doing a lot of issuance at the short end of the market. Because they're issuing at the short end of the market, they are starving institutions like pension funds and life insurance funds of long-dated coupon bonds. In other words, 10-year and 20-year treasuries. So the price of those bonds is artificially inflated. And so if you look at the yields, which is the inverse of the price of a bond, at the 10-year tenor, it's probably about 100 to 150 basis points lower than it should be, okay? And you can look at these calculations mathematically. It's something we do. And that is the distortion that's being caused by what the Treasury in the US is doing. Now, if you hold that thought and you say, well, actually, therefore, if the conventional bond is 100 to 150 basis points lower in yield than it really should be because of their shenanigans, if we factored a true bond yield in that is probably nearer 5.5%, and you look at the real yield on tips, then the break-even inflation rate is not the 2% that's advertised, it's nearer 3.5%. And that's what I think the bond markets are really telling us now, that inflation is higher. Now, the Federal Reserve's never going to change its 2% target, but that would be madness from their point of view. They're going to keep up the pretense.
Yeah. All right. So this was the Federal Reserve. So now the second most important driver, as you said, is the PBoC, the People's Bank of China. So could you explain what happened last week in China? Because I saw they cut their interest rates, and I even saw today they were injecting a lot of liquidity. I think it was 1 trillion yuan to big banks. So can you explain what's happening there?
Yeah, okay. It's I think one's got to sort of start at the beginning with China because it's a complicated situation. The short answer is that as regarding the interventions that the People's Bank and the government have made in the last few days, it's really too early to say and to judge what they're doing and what effect it will have. I know a lot of commentators have sort of jumped up and said, this means X, this means Y. I mean, there's no way they can tell, in all honesty. It's purely for the cameras. The problem that China's got is twofold. One is a cyclical problem, one is a secular problem. The secular problem is that basically red capitalism, if that's the way you can describe it, the Chinese economic model does not work unless the West accommodates it, okay? Because basically what China has needed is use of the dollar. It's effectively a dollarized economy. And also it needs access to Western markets. And if the West makes it difficult for China to use the dollar, and it basically puts tariffs or controls up to stop China dumping goods, then the Chinese economic model founders, and that's exactly what's been going on. So China's found it very, very difficult to continue to grow along trend. That will be something that is not going to be easily resolved. It's not in the gift of China. It's really in the gift of the West or the world economy, I would say, and it will not be resolved overnight, but it was something that will emerge over coming years as to how that circle is squared. The cyclical issue is a different question as well. Maybe it's connected, but it's really a different problem. That is that the Chinese economy went into lockdown rather like everybody else through COVID. But the Chinese economy has never emerged from that lockdown because the Chinese People's Bank has never been able to ease monetary policy to lift the economy out again. And the reason for that was that a target of the Chinese administration has been to keep the yuan, the Chinese currency, the renminbi, if you like, firm against the US dollar. And the US dollar has been quite strong through this period. What's more, the yen has collapsed. And that's put a lot of pressure, downward pressure, on the Chinese currency. And so what the Chinese have been doing through this period has been tightening monetary policy, just at the time when they shouldn't be doing that. And so the result is that the yuan has been held up, but the economy has basically been pushed down. And that backdrop is one which has basically caused deflation. Now, another way to think about this is to think in terms of China overproducing goods, which it's doing. This is the red capitalism model, if you like. China produces a lot but doesn't consume very much. So the excess production is basically sold into the world economy. Now, from an economics point of view, what that means is that if there is that surplus existing, markets should operate to eliminate the surplus by pushing down the real exchange rate. In other words, the exchange rate adjusted for relative prices. And either China's nominal exchange rate falls to clear the market, or prices in China fall, okay? Now, what I've just been saying is that the Chinese have gone to great lengths to hold the currency up. So by holding the currency up in the face of that excess production, it means they put all the pressure on adjustment on prices in both the high street and in asset markets. And consequently, what you've been seeing in China is deflation in both markets. Now, the question the Chinese have got to make is, well, okay, we're looking at this adjustment process. We're already really just started it. And if they're insistent on keeping the yuan up, you're likely to see much, much greater deflation in the Chinese economy. Now, that is impossible because no economy can really stand that degree of deflation without falling apart. So the Chinese really have to do something. And my view is that they've really got a number of choices. Choice number one is that they somehow change their economic model. That's really the structural argument we were talking about earlier on. They're not going to do that overnight. The second thing is that they could basically boost the economy with monetary policy and forget about the yuan exchange rate and allow the yuan to devalue significantly. That is the most likely long-term outlook in my view. So we're looking at a significantly weaker yuan. And just for the record, if you look at what happened in Japan in the 1980s, in Korea and Taiwan in the late 80s, early 90s, in the other Asian economies in the late 1990s, and Scandinavia around the early 90s, these are all examples of countries that basically saw asset bubbles and overvalued real exchange rates. And every single problem was ultimately resolved by a currency collapse. So China is no different here. It's got to go down that same road. Now, there is a short-term alternative. And the short-term alternative is that rather than the Chinese devaluing, the dollar could fall significantly. And that would give the Chinese some room for maneuver. And it may be that there's a deal which has been done. And one of the things that we've been arguing for the last few months is that it looks as if there's been an agreement between the Chinese, the Japanese, and the Americans to basically allow the US dollar to fall a bit. Not dramatically, but fall a bit. And that is being driven by US monetary policy easing. Now, it so happened that in the wake of the US monetary policy announcement of easing by the Federal Reserve, within about a week or so of that, the Chinese have announced this policy easing. So they always say in financial markets, there are no unconnected events, unrelated events. And this is an example of that. The Japanese have voiced, or they said at the beginning of August, which is why the yen jumped up, they were going to tighten monetary policy. Well, forget that. There's no way the Japanese could tighten monetary policy. They can't raise interest rates. Their debt burden is so big, they would just compound their debt interest payments. So they can't do that. So realistically, the only maneuver could be for the Fed to ease. The Fed may have won some quid pro quo from the Chinese. Don't know what that is. Could be connected with Ukraine. It could be connected with buying US treasuries in the long term. I just don't know. But it could be. And therefore, you're seeing the dollar progressively coming down. And that will give the Chinese a window where they can ease policy and somehow dig themselves out of the mess, at least temporarily. So that's what I think is going on. Now, can we infer that from the announcement they made 2 or 3 days ago? No, not at all. Because they were talking about, minor changes in interest rates of a few basis points. They were talking about, letting the banks have an extra $1 trillion by changing reserve requirements. Well, big deal. What they should be doing here is they don't operate, by the way, through interest rates. They operate through the state allocation of credit. It's all about the PBoC injecting money into the money markets, which shadow banks can take up, or it's through directives to the state-owned banks. And so what we've got to look at to judge this correctly is to look at the course of Chinese bank lending over the course of the next few months, and to look to see how much money the People's Bank of China injects into their money markets. But that's something you can't tell on a one-day basis. You've got to look at over the course of several weeks.
Yeah, and another question. So we're talking about China and the PBoC. So China will expand its liquidity. And my question was, so we're going to talk about Bitcoin later in the video, but do you think the Chinese ban on Bitcoin affects it? Will the expansion in liquidity still have an effect on Bitcoin, although it's banned in China? I'm not sure if you have the answer, but I was thinking.
Well, I think that I don't think the Chinese ban really matters to that extent. But the issue that we're really looking at here is that I wouldn't necessarily fix so much on what China is doing with its liquidity in this context. I'd think about the association that the Federal Reserve is easing, and the Federal Reserve is going to have a bigger impact anyway. But what tends to matter for things like the price of Bitcoin and for all assets tends to be, in general, global liquidity, not specific country liquidity. I know I made the point earlier on that the margin tends to be more important for financial assets. That's true. China tends to be more important for commodity markets. That's true. But liquidity is fungible. So, we've got to look at the whole picture. And it's not just China easing in isolation. The US is easing as well. The ECB is easing. I mean, one of the biggest increases in liquidity we've seen this year has come out of the European markets. So it's not just an isolated event here. Most central banks, something like 70% of central banks now worldwide by number, are easing liquidity. The super tanker is turning around.
How much did you say?
70% by number of central banks are easing.
All right. So now let's talk global liquidity's effect on asset prices. So, and I have a quote here from your book. So you quoted the ECB in 2012 saying, measures of liquidity are one of the best performing leading indicators of asset price booms and busts. So basically, if more capital flows into the system, how does that affect the valuation of equities?
Well, quite simply, they go up. But I mean, you've heard it from the horse's mouth. This is what the policymakers are actually telling us.
Yeah.
They're agreeing with this. It's just the trouble is the academics are years and years behind in catching up with this concept.
And is this because of the debasement of the currency, or why is it?
Well, I mean, you could say it ultimately does debase the currency. There's no question about that. But it's really because if I give you more money, you're going to spend it. And what do you spend it on? Well, you might buy yourself a new sports car, or you might buy, a new suit. But ultimately, if you've got lots of liquidity left over, you're going to put it into financial assets.
Yeah.
And it's as simple as that.
And how come it moves in cycles?
Well, that's an interesting question. I think the question, what it really comes down to, I would say, is really 3 different things. Okay. One is that we must recognize there's a cycle in policy. And that cycle in policy could well have political drivers. So it may be that despite what is said by the Federal Reserve as being independent or central banks being independent on paper, they are influenced by politicians and by the political cycle. That may be the case. I mean, clearly, if you look at the Federal Reserve right now, there's been a lot of debate about whether the interest rate cut was political or not, whether it was trying to, help Kamala Harris become elected. So we've got to acknowledge that's true. The second fact is that liquidity, if liquidity is in financial markets, is not in the real economy. And liquidity can't be in two places at once. And so if you've got a very strong real economy, then you're going to get very weak financial markets because money will be sucked out of the financial sector, and equally vice versa. So what we're really saying is that if there is an economic cycle, what you're likely to see as well is that economic cycle being reflected in financial markets. So in other words, strong economies don't have strong financial markets. It tends to be weaker economies have strong financial markets, which is the paradox. And then the third thing, which is probably the most dominant, is about debt rollover. So I mentioned earlier on about the maturity wall. That maturity wall, is not there this year, and it's probably not around very much next year, but it's certainly really coming in 2026. And that maturity wall will mean that a lot of liquidity is likely to be used for debt rollover. So that's another use. So what you've got is a cycle. Our view is that the cycle is about in fact, our estimates are 65 months. And that may seem an overly precise figure, but let me explain how we got there. We did what is called technically or mathematically Fourier analysis, which is basically sort of fitting cycles, sine waves, if you like, to data series. And we did an exercise back in year 2000, so almost 25 years ago now, where we basically had our liquidity data going back to 1970, and we fitted a Fourier analysis to that data series, and we came up with the fact that the cycle is moving with a frequency of about 65 months. Now, we haven't changed it since year 2000. We've just let those cycles run on. But remarkably, they capture the bulk of movements of inflections in global liquidity. So it seems as if there is a fairly regular pattern. Now, it so happens that 65-month period on average is the average maturity of debt in the world economy. So in other words, what this liquidity cycle is dominated by is a debt refinancing cycle. And that's how I would best explain it.
Yeah. And so, then the thing is, if it's widely known that investors know that the global liquidity moves in cycles, doesn't that mean that investors can easily profit from it? And doesn't that also mean that efficient markets don't work?
Well, you're right. I mean, I suppose I think that if you go back to the fact that, let's take your first statement. Can investors profit from it? Yes. Do investors profit from it? Yes. Do all investors profit from it? No. Because there's a large constituency out there who basically does not believe in the concept of liquidity. People say, it's subject to the greater fool theory. Why aren't markets efficient in the sense of a textbook sense? That if we know all this, why is it that that markets still move up? Now, there's an interesting, joke or anecdote, which is that two economics professors are walking across a lawn in America, and one of them spies out of the corner of his eye $100 bill, and he bends down to pick it up, and the other professor says, "Don't, because we're in an efficient market world. That doesn't exist. Someone else must have picked it up before you." And that's really that I think explains really what's going on, is that you've got to understand that if there's more money in the system, people will react to that. And markets may be great at discounting information, but they also respond to liquidity. And if liquidity is going up, more people are going to buy. If liquidity is going down, they're going to be forced sellers. And the way that we think about markets is not really from the perspective of individual securities. It's through the mass of investors. And we recognize the fact that investors operate via constraints. They have liability constraints they've got to make. So, for example, think of your retirement or whatever it may be. You've got to have assets in place that are going to give you an income or are going to be of sufficient worth, by the time you retire, so you can live without working. And that's clearly a constraint, but that's actually dictating your investment patterns. So these factors tend to be more important in our view in terms of understanding financial markets.
All right. And I think this is the question that everybody wants to hear from you. So is global liquidity expanding for the moment? And where is it headed in the near future?
Well, again, I think you've got to differentiate the trend from the cycle. The cycle bottomed in 2022, in late 2022. That bottoming coincided with the British gilt debacle, the sell-off in the sovereign debt market, when the new Prime Minister enacted a budget. Prime Minister Liz Truss came in with a ill-thought-out budget. The sovereign debt market sold off. That was an immediate wake-up call for central banks and treasury ministers worldwide. The Bank of England, with alacrity, changed from QT to QE, overnight, pretty much. And the Federal Reserve began to change its policy and added more liquidity to markets. So at the end of the day, what this is really telling us is that despite the remits of central banks supposedly against fighting inflation and employment, what their real or true goal is to preserve the integrity of sovereign debt markets. And that's exactly what happened at that point. The liquidity cycle has been increasing from that point. We think it's likely to peak out in late 2025. It's still going up now. It's exactly on track, so there's no question about that. The wobble in markets that we saw in August of this year, at the time when the Japanese yen spiked, was purely a change in risk appetite, risk exposure, as we said at the time. There was nothing about deteriorating liquidity conditions. Liquidity has continued to expand, and I think the pickup in gold is a test to that. So gold is making all-time highs the whole time. Liquidity will peak, or the cycle will peak, in late 25 for the reasons I've already articulated. So I think that there's a maturity wall of debt that's got to be refinanced. I think the world real economy could be stronger by then, and it's conceivable, at least not impossible, that policymakers could by that stage be thinking about tightening policy again if inflation becomes more of an issue. So I think these are factors to take into account. However, what we also got to accept is the trend in liquidity is a lot faster. And the trend in liquidity is a lot faster because government deficits are bigger. And if you take it again, looking at the US as a benchmark, and again, I'm not hitting on the US is in many cases the sort of cleanest shirt in the laundry, but the US has the advantage that it's very transparent. They provide lots of data. They project into the future, and one can actually analyze the US fiscal situation in great detail. And the Congressional Budget Office produces an excellent series of projections of US debt, US spending, and US tax revenues. And if you look at spending outlays currently, as we speak, are 40% higher than they were before COVID, 40, okay? There's been a step change. Taxation hasn't gone up to anything like the same magnitude. It's very difficult to increase taxes on people, I would venture that none of the presidential candidates in the US, and none of the political parties are talking about cutting back on spending or raising taxes, enormously. So these deficits are going to be embedded. The Congressional Budget Office projects that the US fiscal deficit is going to run on at something like 5 to 6% per annum over the medium term. And this is a structural deficit. It may even be more than that. We've got to add into that extra defense spending, of course. And the CBO never projects future recessions, which also cause bigger deficits as well. So they're likely giving an underestimate of the truth. Historically, we've been used to 1 or 2% deficits, or deficits of 1 or 2% of GDP, I should say, for a few years, but nothing of this magnitude that they are projecting for the future. That has to be funded, and that is a good benchmark as to the sort of growth in liquidity that is likely to be required. So that will translate into something like an 8 to 10% annual increase in liquidity conditions. For the US, and that will translate worldwide as well. And so what you've got to do is to think about that in terms of asset allocation. If you've got monetary inflation of 8 to 10% per annum, what assets should you own? And I think the answer has got to be dedicated monetary inflation hedges. We know that gold is the long-standing beneficiary in that regard. It's had an excellent performance this year. It's had an excellent performance since year 2000. It's probably had an excellent performance since year zero, in fact. Simply because gold is a traditional monetary hedge. And Bitcoin has proved itself in the last 5 years to be a great monetary hedge. It's been digital gold in many cases. Now, I'm not an expert on Bitcoin nor on crypto, so that's a wealth warning, but it seems as if what you see is what you get here. And if you've got monetary inflation, you really want an asset where you've got limited long-term supply. Bitcoin is cut off at 21 million Bitcoin, so we're getting close to that threshold already. And the other thing that Bitcoin probably offers is security. I mean, it's a decentralized system. It's got protocols that work and look to be secure. So at the end of the day, maybe it's a decent asset for people to think about.
Exactly, and that's what I want to talk about right now. So we've established what global liquidity is, where it's headed, what its main drivers are. So now just as you said, why is it so important? Why is the correlation so important from global liquidity and Bitcoin? How come it's so correlated? Is it because it's a good monetary hedge, or because of the scarcity you just said?
I think I wish I knew the answer, Jack. I think what it comes down to is probably thinking in these terms, that if you think about Bitcoin, and this is my interpretation. So I mean, it's pure speculation. If you think of Bitcoin, there are two dimensions. There's an intensive margin and an extensive margin. And let me describe what I mean by that. The extensive margin is lots of people owning $100 of Bitcoin, okay? And that moving from, let's say, 10 people to 100 people to 10,000 people to 1 million people to maybe 10 million people. Now, that's the extensive margin growth, okay? And that is like the take-up of anything, be it transistor radios to the internet to mobile phones. You get an S-shaped growth curve reflecting the take-up of new technologies. So that's the extensive margin. So Bitcoin is following that S-shaped growth curve. The other element is the intensive margin, and that's where the monetary hedge bit, I think, comes in. And that's really like saying, I've got $100 in Bitcoin now, but I think there's going to be more monetary inflation in the future. Therefore, I'm going to put $5,000 in Bitcoin. Or if I'm an institution, I might say, well, I'm going to put, $50 million of my institutional money in Bitcoin. So that's the intensive margin, and that's much more about monetary hedge. So I think if you put these two things together and multiply them, the intensive margin and the extensive margin, you probably get somewhere to explaining why Bitcoin has been going up so much, in the last 5 years. It's highly sensitive to liquidity, that's for sure, but that may be a slightly fake statistic or exaggerated statistic, overestimated, simply because you've got to allow for two things. One is the monetary inflation dynamic, and the other is the S-shaped growth curve of a take-up of a new product.
Yeah. And then, so I think, for example, myself and every analyst in Bitcoin is currently trying to value Bitcoin, trying to find a good valuation method on how to value Bitcoin. And there's one really good one I saw in your book, but you didn't talk about Bitcoin, but I think it can be applied. So basically, since we can not use traditional PE ratios to value Bitcoin, since there are no earnings, in your book, you mentioned a different valuation method, the PM ratio, so the price to money, or the investor power model. And this really piqued my interest. And do you think this can be something that can be applied to Bitcoin? And have you modeled it out yet?
Absolutely. But I mean, that's pretty much what we do when we try and understand asset allocation, is to look at these relationships. So one of the things that I can't remember if I put this in the book or not, but it's certainly something we've expressed over the years, is that one established monetary inflation hedge is gold. Okay, gold at the moment is, I think, about 1 or 2% by value of all financial assets worldwide. In the 1970s, and I just about remember the 1970s, but in the 1970s, I'm sure I'm correct in saying that a lot of Swiss banks or wealth managers would have had at least 15% of their clients' portfolios in gold. Okay.
Okay.
Not 1%, not 2%, but 15%.
Okay.
Now, if we're in a monetary inflation world, we're likely to get gold becoming a much more substantial part of portfolios. Now, we can debate what that may be, but let's say goes to 5%. So, in other words, the stock of gold or the value of gold in portfolios will at least double, more likely triple from where we are now. Okay. Now, Bitcoin is nowhere near the percentage of gold, right? And I would have said Bitcoin, if it's a viable monetary inflation hedge, has to get somewhere near the capitalization of gold, as it is now. But it may even be that Bitcoin has to get up to where gold will eventually end up, which may be 5% or so of portfolios. So I think that's the sort of benchmarks I would tend to think of. And if I come back from sort of first principles and I say, well, okay, if I'm dividing up a portfolio myself in terms of asset allocation, let's think about a good long-term portfolio that would be robust to events and robust to monetary inflation. I'd be putting something like 60% of that in equities and good quality equities. I'd be putting the other 40% probably distributed something like 10% in things like gold and Bitcoin. So you could take five each, for example. I'd be putting some into prime residential real estate as an investment because that's a pretty good long-term monetary inflation hedge. I'd be thinking about treasury inflation protected securities. And then I might put the other 10% in things like cash or high yield bonds or something like that. But I would not have government bonds.
Have you heard about the 3-pillar portfolio from Lynn Eldon?
No. No.
I think it's exactly what you're describing.
Right.
So I think every major macro analyst agrees that currently we have to prepare for a monetary hedge, and I think Bitcoin and gold play a big part in that. So moving on, so as well in your book, you mentioned global liquidity index precede asset price moves. So bond markets and forex by 3 to 6 months, equity markets by 6 to 12 months, and the real economy by 5 to 20 months. So what about Bitcoin and gold?
Yeah, very, very good questions. I mean, those factors that you or those lead times that you cited, we actually prove that empirically in the book. So we do statistical analysis to show those lead times, and we corroborate that by using things like Granger causality analysis to actually establish that in a robust way. We've used similar tests for gold and Bitcoin. The interesting fact is that if you look at gold, gold and global liquidity tend to have a sort of mixed relationship. There are times, I will accept that gold can lead global liquidity, but most of the time global liquidity tends to lead gold. And the lead time has been about 3 to 6 months, generally speaking.
Yeah.
If you look at Bitcoin, and actually this is fresh in my mind because I was only doing it in the last few days, again, refreshing the data. It seems that Bitcoin is moving with a remarkably short lead time of about 12 weeks. And I don't know why, but it seems to be uncannily the case.
Yeah, and so that's what I wrote down as well, 8 to 12 weeks. And the thing what you say as well is interesting because you said gold precedes global liquidity by 3 to 6 months.
No. I said there are times when gold can proceed, but generally liquidity leads by about 3 to 6 months.
Okay, because I have another Bitcoin analyst, Charles Edwards, and he says that Bitcoin lags gold by about 3 to 6 months. I don't know if that's correct and that you have the same research.
Well, I was looking at this recently, and I mean there is a case for saying that that's true. Yeah, I mean, but it's I wouldn't want to hang my hat on because it doesn't look a particularly strong relationship. But there is a case for saying that for sure.
Yeah, and I think if you read this, it was just released yesterday. So Lynn Eldon put a research report of global liquidity and Bitcoin. And apparently the directional movement is 83%. So if global liquidity rises, 83% of the times Bitcoin rises as well. And this is the highest correlation in every asset. But I don't think she measured it in global liquidity. I think she just used M2.
Well, that may be. I mean, I'm my background is a statistician, so I'm extremely cautious about anyone saying you get very high correlations of that magnitude. I mean, that sounds to me like spurious correlation. I'd like to see that, but you've really got to. I mean, the whole problem is, without getting into the weeds of statistics, I mean, the question is that those two series are they're going to be co-integrated. So they're dominated by a trend. So what that 83% is picking up is largely a trend, not a fluctuation, which is slightly different. But I mean, I take the point without stealing her thunder that they're clearly connected. I'm just questioning whether it's an 80 to 83% R squared, which seems remarkably high.
I can send you the report later.
Do that.
And so why do you think Bitcoin is so sensitive in moves to global liquidity more than other assets?
Well, look. All I'd say is that I think that it's a cleaner asset class than gold in terms of its monetary inflation hedging properties. And the reason, and I'm just saying this in terms of looking at a number of dynamics. I mean, if you come back to, why is this a monetary inflation hedge? It really is two things. One is that it's secure, right? The technology is secure, the ownership is secure, etc. And the second thing is the supply is limited. And it's those two factors that drive the demand for Bitcoin. Now, if you look at gold is secure, but there's a problem with gold, is it's really quite heavy and it's very difficult to move around. So you've got to discount gold a little bit for that factor anyway. The other thing is that the supply of gold is a sort of, difficult to analyze, because you've got, first of all, the bullion banks who operate the gold market, who do a lot of surreptitious dealing and short selling and whatever. And it's very difficult really to understand the dynamics of what's going on short term with gold. I mean, there's a lot of manipulation of the price, in my view. Supply is also a question. I mean, you have got supply coming onto the market from private producers, but then equally what you've got, which is disturbing the situation, is that central banks, particularly, let's say, let me say central banks outside of the West, so China, Russia, the BRIC economies and their friends, all want to accumulate gold as part of their foreign exchange reserves. So that's also creating a dynamic which is interfering with the normal trends, and that may be something which has propelled gold upwards in the very near term. So I think that you've got those factors to come into account. So I think, generally speaking, Bitcoin seems to be cleaner. There's you've got security, you've got fixed supply. The one uncertainty, which I'm not an expert in, and I don't know how to to quantify it, is there may well have been short selling of Bitcoin because of the ETFs. Now, I don't know if that's for sure, but I would suspect there's something like that's going on. So we may have another uncertainty in the near term for Bitcoin. But ultimately, Bitcoin is fixed supply, gold isn't.
Yeah. All right. And then, so I heard you saying this in another podcast. So how much does Bitcoin and gold rise by an expansion in global liquidity, percentage-wise?
Well, I can give you the historic data. And the historic data is that, and this is based over the last 5 years, and this comes from regression analysis. So again, it's a wealth warning because it won't be the same in the future, but it will give you a benchmark. Gold is a multiplier of about 1.5. So for every 10% increase in liquidity, you get a 15% expansion in gold. Okay. And that's more or less actually what's happened this year. I mean, it's not been that out of line. If you look at Bitcoin, the answer has been 4.5. So it's been a 10% increase in liquidity, 45% increase in the price of Bitcoin. Will that be true going forward? Unlikely, but it will still be a high number.
Yeah. And so then I was thinking, based on that, so you say that the global liquidity cycle will topping in late 2025. And how much do you expect the global liquidity to increase? And based on that, if it's, I don't know, say 50%, then you have to do the multiplier of 4.5, and then we can maybe have like a Bitcoin cycle top price based on that.
Yeah, well, I think I did a podcast a few days ago where I was talking to people who look at power laws in Bitcoin, and we both concluded, my independent assessment, there'd be a peak, albeit maybe a temporary peak in Bitcoin around late 2025, and they came to exactly the same conclusion, looking at mathematical algorithms rather than my analysis of liquidity. So there may be something in that. I don't know. Who knows? But at the end of the day, I come back to the point that there is a trend and a cycle. And the cycle is really a cycle in growth rates. So you're going to get, growth, accelerating over the next 12 months, but peaking out, and then ultimately the cycle coming back to trend and moving below trend. But that trend is rising fast. And as I said, the trend is rising at a rate of about 8 to 10% per annum.
Okay.
Now, if you just look at compound interest, that means that the stock of liquidity is doubling about every 10 years. In fact, it's less than 10 years, but it's doubling about every 10 years, let's say. Therefore, the price of Bitcoin should at least double every 10 years. But if you've got a higher multiplier on Bitcoin, then you've got a scale factor increase.
Yeah. And so how much do you think global liquidity will expand in percentage till the top in late 2025?
Oh, I think that, I would imagine that we're probably going to see an increase from here of about 15%.
All right. So, and then we do that times 4.5, and then we have our Bitcoin price for the cycle.
Yeah, but that would be the top. But I mean, you can put a ruler on that and see where you get to. Yeah.
And do you think that will get front run? For example, you said that Bitcoin lags global liquidity by about 12 weeks. So
that's what the data shows.
So do you think then the Bitcoin top will be 12 weeks after the top in global liquidity?
Could be.
Or do you think it will be front run?
I don't know. I mean, I think that, one of the things that you've definitely seen in markets, I mean, this is without question, that time lag between a move in liquidity and a move in Bitcoin has actually concertinaed inwards. It's basically got narrower and narrower, shorter and shorter. So, if you go back 4 or 5 years, it was counted in months. Now it's counted in weeks. Now, what's the reason for that? I don't know. But all I'd say is a lot more quant funds, the big quant funds, are actually looking at liquidity. We supply data to a lot of the big US quant funds. And, maybe they're using this as part of their input. I don't know.
All right. And why do you think Bitcoin has a higher multiplier than gold? Is it because of it's a smaller asset?
Well, I think you've got to come back to my analogy of saying you've got this intensive and extensive margin, which are driving growth. I think you've got the S-shaped growth curve of this take-up of Bitcoin because it's a new technology. More and more people are buying it. There's more people with $100 in Bitcoin, but that's growing fast. That's coming on top of the intensive margin growth. So I think you've got these two things coming on top of one another. That's what I would argue.
All right. And then another question is maybe a little more crypto related. So when during the liquidity cycle do you want to go further down the risk curve? So for example, that you would go from Bitcoin to even maybe altcoins and maybe even meme coins. I don't say you want to do this, but maybe some listeners want to go further down the risk curve. And when exact in the global liquidity cycle would be a right time to do that?
Well, the answer unquestionably is near the bottom of the cycle, not the top. You want to buy at the bottom and sell towards the top, and that's for sure. So we're about midway through the cycle right now in terms of liquidity. I mean, the sort of caveat here is that as I say to people, look, I mean, bull markets always climb a wall of worry. Other people have been saying, don't invest, the whole thing's going to fall apart. We're about to hit a bear market. Valuations are too high. They've been saying that for the last 2 years. Okay, market prices have still gone up, and you've got to accept the fact that investing from now until late 25 is not going to be anything like as rewarding as investing starting 2 years ago. Okay, so a lot of the gains have already passed us by. There will be further gains, but it's really a question of rotating into other assets. It so happens that I think gold has still got much further to go. And I think Bitcoin's got much further to go. I think that commodity-related stocks have got further to go. But, I wouldn't necessarily believe that you're going to see, the same sort of gains out of the US stock market that you've seen for the last 2 years. I mean, that's probably coming to the end of the party or towards the end of the party. Better to start rotating into other areas of the world.
Yeah. But isn't it when there's even more liquidity in the system, people get even more risk on and even riskier assets perform better?
Yeah, that's true.
Towards
but then
the
you've
top
got
end of the cycle?
yeah, that's true. I mean, things you get acceleration for sure, but it's a higher risk time to invest.
Yeah, of course.
If you think you can get out, as they say, enjoy the party but dance near the door. That's the thing. You've got to be able to pull the trigger quickly.
Yeah, and that's maybe a difficult question. What assets do you think will perform better when the cycle is coming down again? So when liquidity is decreasing again?
Well, okay. I mean, it depends. I suppose it depends a lot on the nature of how quickly liquidity comes down and why it's coming down. But I would tend to think that you would expect at that stage that government bonds would perform well because they are still considered to be the safe asset in the system. So I think one's got to recognize that there may be a temporary window for performance of government bonds. And I'm cynical enough to suggest that at some stage governments will want to push people out of risk assets back into the sovereign debt markets so they can improve their funding abilities. So that must be the case at some stage. Cash is always a pretty good investment to have, but maybe, and I just raise this a point, maybe the world is getting wiser to what the central banks are doing, and they realize that if there is a fall in liquidity and there's a risk of financial crisis, that they know that central banks will come back in again. There'll be a Fed put or whatever you like to call it, which will support the markets. And that's a realistic statement. The simple reason that we're living in a very fragile financial world of existing world where you've got existing these big debts. You've got the existing structure of financial markets, which are very, very fragile because they're based on weak collateral and lots of leverage. And you need the central banks there to paper over the cracks all the time. But the more that central banks paper over the cracks, the more they pump in liquidity, the more monetary inflation you get, the higher the gold price goes and the higher Bitcoin goes.
Yeah, so that's why I'm a bit skeptical of the cycle right now. Do you maybe think it can go even further than late 2025?
Well, it's always possible. I mean, what do I base that 2025 view on? I base it on the fact that we've seen since the mid-1960s, 65-month cycles repeating. Why is that the case? I don't honestly know. My conjectures come down to it's a debt refinancing cycle, and therefore I think I've got to go with the data and think that's what's going to happen again. I may be wrong, and because of this debt wall or this maturity wall that we've got, maybe it's pushed out a bit more. I don't know. Maybe central banks have got wise to this and they think, well, we've got to add a lot more liquidity to the system to prevent there being major default. I mean, the other question to think about is, will there be another financial crisis? Yeah, there will. Of course there will be. Because the fact is that debt grows exponentially and liquidity is cyclical. So you look at those two mathematical curves and they're bound to move apart at some stage.
So there might be a recession or a crisis right after the top of the liquidity cycle, you think?
Quite possible.
All right.
Quite possible.
And then cash would be the better assets, or still gold and Bitcoin?
Well, no, I think what history shows, and it showed definitely in the case of 2008, in the case of gold, is that gold sold off because basically it's a very liquid asset, and if people are doing fire sales of assets, if you've got a block of gold and you're looking at your Nasdaq stocks, and your Nasdaq stocks have just fallen 80%. You're more willing to sell your gold, right, than try and liquidate your technology stocks. So I think that those are the sort of assets that become very liquid and very transferable in a situation where you're going to market crash. Bitcoin, I'm not sure. I mean, the trouble with Bitcoin is there's an awful lot of emotion in Bitcoin too.
Yeah. All right. So this was it. Let's maybe wrap it up. To recap, what are your final thoughts on Bitcoin and global liquidity for the rest of the year and maybe next year?
Well, I think that the most important thing for people to look at, or to understand at least, is this global liquidity concept. I think that's the all important one. Certainly, it is for me. So it's a question of not watching central bank interest rate discussions or whatever and getting overly fixated by what the FOMC in America is doing. It's actually looking at the amount of liquidity that's being created in the system. That's important. I think that cycle is still going up. That cycle hit bottom in late 22. It's likely to hit its peak around late 25, I think. We've still got further to go. What does that mean for Bitcoin, gold? I think that both of them can push higher. Gold is already at an all-time high, but I think it's going to go even higher. Bitcoin is not far off its all-time high, but I think that's going to go higher as well. I think these are assets you hold for the long term generally, but one has to recognize the cycle. The cycle is coming down, as I said, probably in about 12 months' time. And that may be a bump, who knows? But at the end of the day, think about the compounding effect, the trend that's going on behind that. And global liquidity is compounding over the next few decades at 8 to 10% per annum. And that's the reality. That's all about the big debt burden we've got in the world economy. And debt ain't going out of fashion. Politicians are just kicking the can down the road. They're taking on more and more debt. That easy.
Amazing. So one last thing. So I believe a lot of my viewers look up to you. So if you would give them one piece of life advice, not financial advice, life advice, what would that be?
Don't get overly fixated by financial markets. Go and do something more interesting like art. Paint a picture. But something like that, I don't know. Travel, paint a picture. Listen to good music. Buy nice wine. Yeah. But if they want to contact us, it's the best avenue is probably Substack, which is Capital Wars, named after the book I wrote about 5 years ago, Capital Wars on Global Liquidity. Or we've got a website, which is an institutional research service, which is www.crossbordercapital.com.
Thank you so much, Michael.
Good. Thank you, Joe.
Thank you.
If you liked the video, don't forget to hit the like button and subscribe to the channel. Also, make sure to follow me on X, where I post daily market analysis on the crypto space and macro. And if you're interested in learning more about global liquidity, I highly recommend Michael Howell's book, Capital Wars. You can also check out his Substack at capitalwars.substack.com. And follow him also on X at CrossBorder Cap. For a quick recap on this topic, you can also watch my 14-minute video on global liquidity. Thank you all so much for watching, and see you all into the next video.